Hey everyone, it's a great pleasure for us to be guests today in the beautiful rooms of Syz Bank in Geneva, Switzerland, and to sit down with Charles Monchau, CEO of Syz Bank, and discuss finance. Hello, Charles.
Yeah, hello. Thanks. Thank you so much for having me.
The first thing I noticed when I came across you was your academic background and education. For example, you hold a master in finance from HEC Geneva, but you have also completed numerous executive programs such as from i.e. Business School, MIT, University of Oxford, University of Cape Town, and LSE. And then you have completed a CFA, a CMT, a CAIA, and a CIIA. I assume you have great passion for academia, lifelong learning, and self-development, right?
Yeah, that's correct. Well, the thing is that when I was young, I was not that passionate about studies, so I wanted to finish my master's, as soon as possible, and this is what I did. And then when I started to work, I really, start to have a true passion for finance, and also I had a very, let's say, um, very clear targets of where I wanted to head to. And my target was to become chief investment officer. So what is a chief investment officer? Is basically oversee all of the functions of an investment department. Will it be within a bank or an asset manager? And this is the kind of, let's say, job where you need to multitask. You need to understand about the business. You need to be able to present, do marketing, but first and foremost, uh, perfectly understands all asset classes, will be fixed income, equities, hedge funds, and so on. So this is how, when you are passionate about something and when you have very clear targets, you know where you are heading to, and you have all of the energy and passion to do it. And this is how I started to take different exams. Will they be quite technical about finance, like the CFA, for instance, or the CMT, which is a Charter Market Technician Analyst diploma, but also other kinds of, let's say, studies like executive MBA. For instance, executive MBA, you don't necessarily, let's say, learn about finance, but you learn about what is a business plan, how to, let's say, market, a very specific topic, also to interact with different, type of professionals, not only finance professionals, but also lawyers, doctors, businessmen, entrepreneurs, and so on. So I think it's the reason why I took all of these exams is that I really wanted to build my own toolbox, and within the toolbox you have experiences, obviously, but you also have the academic backgrounds, and this is why I had these different type of certifications.
So you grew up in Switzerland, I assume?
No, so I was born in Greece. I grew up in Africa, and I landed in Switzerland when I was 15 years old.
Okay.
I finished my studies there. I became Swiss, and this has been, let's say, the country where I spent the most years in my life. So it's true home. Yeah, exactly.
Okay. As a young man, could you have ever imagined being a CIO of a private bank? What were your early career goals?
Yeah, so I think this is an interesting question because it just shows how important it is to do some internship. So the thing is that I finished my, let's say, normal studies quite young because I finished my master's degrees when I was 19 years old. So I was very, let's say, immature, I think, professionally speaking. I didn't know at all where I wanted to go.
Yes.
My only passion at the time was horse riding, so I was doing show jumping. So this
Horse
was
riding.
was my only passion. And then, because I also wanted to let's say earn a little bit of money, so I started to look at some internship where I was going to be paid, because horse riding is a quite let's say expensive leisure. So I headed in the bank with absolutely, let's say, no big interest for a bank. So I headed it to a bank for internship, and then I started to really, let's say, love what I saw. So I was sitting in the middle of a trading desk, and I really got fascinated by all of these, let's say, day-to-day activities. So there was, every day was different. There was a lot of things happening. Was very energetic. So I really, let's say, love what I saw. And then indeed, the boss of, let's say, the whole investment departments sitting nearby the trading desk was the CIO of the bank where I work. I started to do the internship, was BNP Switzerland at the time. And then, I started to look at, what it was doing on a day-to-day basis, and I found, let's say, very interesting to multitask on, again, meeting clients, crafting new investment products, think about the investment strategy for the banks, but also run a team, and motivate all of the team members around, let's say, a common mission, which was, let's say, the success of the investment department. So that's really what, let's say, led me to think about becoming a CIO. And I knew that the path was quite difficult and a long one.
Yes.
And that to go, let's say, to move to the top of investment departments, you really need to know what you're talking about. So it's about, let's say, understanding all asset classes, about understanding the macroeconomy, also be able to analyze companies, be able to analyze the funds, be able to also to, let's say, make an investment story simple in front of clients. So it's really, let's say, a job where you need to multitask, and also you're basically paid to follow what is happening on a day-to-day basis in the world. Not only financial markets, but also geopolitics, macroeconomy. And if you are curious, if you are fascinated about what is happening, not only on financial markets, but again, around the world, I think it's a fascinating job.
So your internship had major impact on your
And
career.
I think this is why, by the way, I always have some interns, because usually they are very let's say efficient and passionate about the job. But it's also for them a unique opportunity to test whether or not they are able to let's say follow a career path within the bank. Saying to someone, my passion is financial market, I think it sounds weird for many people. But for those who really like the markets, it looks quite, let's say, it's possible to indeed have that kind of passion, because again, financial markets, every day is different. It's a long story of long school, let's say. It's a school of humility. Yeah. You're always, let's say, surprised when you read, let's say, your predictions at the end of the year, and you come at the start of the year, and you come at the end of the year, and then you look at your notes about what you were predicting, and most of the time, it's difficult, to be right on all of these calls, because there are so many unknowns which happen every year. So I think that's what makes the job, let's say, quite interesting, is these let's say, having to deal with uncertainties about the unpredictable, and try also to manage risk and find the best investment opportunities. So it's really about, let's say, using your brain, using your experience, using also your feeling.
Yes.
To try to, let's say, to read the markets and take the best investment decision.
Was it difficult for you to quit short jumping for finance, and do you see similarities between sports and finance?
So first, was it difficult to quit horses and show jumping to move into finance? Well, the good news is I was not good enough in show jumping. So and I think luckily, I didn't stay with horses, because my life would have been very difficult. So I think I was better as let's say as a financial professional than as a horse rider. So luckily, I moved, but I still have a passion for horses. But obviously, it's a very it's a sport which takes a lot of your time. So you need to make a choice at some point, and my choice was clearly to let's say improve into the financial world. Then regarding your question about similarities between let's say horse riding and finance, I would say, generally speaking, and this is what I let's say tell to my kids, is that it's always good to have some, let's say, sport experience and exposure, because sports learn you so much that you can then use in your professional let's say career.
Yes.
First, it tells you that if you are not prepared, you're gonna fail. So it's a lot of work. Will it be show jumping or tennis or team sports? You need to work hard, and if you don't work hard, you don't improve and you don't have results. That's point number one. Point number two is what do you learn from mistakes? I think it's easy to win. When you win, everything is easy. You don't need to extrapolate. But then what do you do with the failure?
Yes.
And the same applies to finance and trading. What do you learn from having been wrong on something? Is it just bad luck, or is it because your due diligence work was not good, your analysis was not good, because you overreact to something, you were too, let's say, sentiment driven instead of fact driven? There's always something to learn from mistake, and this applies to sport, obviously, but this applies to a professional, let's say, career as well.
Yes.
And especially to finance, because finance, every year you're going to make mistakes. And the key question is, what do you learn from mistakes? What do you do once you have spotted where you did wrong, and then when you understand why you did wrong? And this, I think this is key. And this is what I think anyone learn from sport or music, or let's say any leisure activities that can really teach you something about life and then your work career.
I did short jumping myself, and it is essential to trust your horse and your team. Do you see also any similarities in this respect?
Oh yeah, on this, yeah, obviously. And then and then if your horse feel that you are not, let's say, that you don't trust
Exactly.
let's say the horse, then it's not possible to go at the end of the competition. So I think that the same apply indeed to a team.
So yes, before joining Syz Bank, you worked for a number of prestigious companies such as BNP Paribas, Lombard Odier, Rothschild, HEC Bank, Deutsche, and Alma Capital. Your work has essentially always been in the field of asset management or portfolio management. What fascinates you about investing? So why did you become an investor rather than an investment banker or consultant?
Well, I think there's nothing wrong about with having been as a consultant or investment banker. I'm sure that I would have let's say enjoyed myself doing this. But I think the thing is that working with an investment department, will it be as a portfolio manager in a bank, or let's say investor with an asset manager, I think you need to be passionate about financial markets. So financial markets, they fluctuate every day, very often in a way that no one was expecting. And I think that makes, let's say, the tempo quite different than being a consultant or investment banker. Investment banker, you are very deal oriented. So certainly, you're going to invest all of your time into a specific deal. And once the deal is done, then you move to the other one. So there is no, let's say, daily fluctuation. It's really about, let's say, closing a deal on time and doing your best. Then consultant is to think about strategy for at least that's the way I understand it. To think about the strategy of one business and try to find solutions, present solutions, so on. It's very interesting, but it's not, let's say, similar to the day-to-day activity of an investment manager.
Mm-hmm. You've mostly worked in the private clients division of banks, but also for institutional clients like at Lombard Odier. What are the biggest differences between investing funds from private clients and institutional investors?
Yeah, it's a very interesting question. At the end, there are not that many, let's say, differences, because they both type of investors, they don't like risk and they enjoy the upside. So I think that's one similarity. But definitely, the difference is that a private investor is looking at his or her money really, let's say, very closely, very often in quite emotional way, because that's the money which has been earned or inherited. So if the capital is down, that means that there is immediate effects on the person. So there is probably more emotion than with institutional investors. Institutional investors usually they have a much longer time horizon, and they are not really running their money.
And they're professionals themselves.
They are professionals themselves, but that means that yes, maybe they have, on average, they have, let's say, higher knowledge than the private investors. But on the other hand, the mandate is quite different, because It doesn't mean that they are less risk averse, because their risk aversion is basically losing their job.
Okay, yes.
So they don't want to take too much, let's say, also risk. You know, they need to come with investment decision which is non-emotional and much of the time, let's say, very well documented. They need to present the investment idea and they need to report, usually to advisory boards or to a boss, you know, how the investment is doing. A private investor, you talk to the boss, you know, he's the boss of his or our money. So it's much more direct than institutional investor.
You've worked for family-owned private banks such as Rothschild and Syz, but also for large publicly listed banks such as BNP Paribas. Do you see a big difference in the corporate culture?
I think a family-owned bank is definitely very different than, let's say, listed bank. I think a family-owned bank is much more aligned with its clients. You know, here at Bank Syz, so Syz family is a family of entrepreneurs.
Because they invest with the clients together.
And basically, yes, when they very often co-invest with the clients. So, you know, here the message is very, very, let's say, simple, is that we are entrepreneur, family-owned bank, talking to entrepreneur, family-owned businesses, and very often investing into family-owned businesses. So here you can see the full alignment, and actually, you know, it has a lot to do with corporate governance. So corporate governance with family-owned businesses will very often be a much better quality than most of the listed group. So there is not only, let's say, a corporate governance issue, well, not an issue, let's say corporate governance super advantage of, you know, working with a family-owned bank, but also in terms of the quality of the discussions you can have with clients, the long-term vision of the bank. You don't need to report earnings results on a quarterly basis, you know. You don't need to take crazy risks because you need to beat, let's say, the earnings of last year. So we don't do investment banking. We don't do asset management. We are not using our balance sheets, you know, to a large extent. So the risk taking is quite low, and the focus is very simple. You know, it's really about wealth management and taking care of our clients. So I think it's a higher quality value proposal with much less risk. And by the way, you know, when you talk about private clients, they don't want to take risk. You know, they are in the business of not becoming rich. They are in the business of staying rich.
Yes,
That's very important. So if you want them to stay rich, when they move their money into a bank, the bank in question needs to, let's say, be very careful with the way, you know, they run their business, because your clients don't want you to take crazy risk. And this is our value proposal, basically.
So it's very much about skin in the game, alignment of interest.
Exactly.
Yes,
I think it's a good summary.
So now, please give us a brief market outlook now, Charles. In your opinion, where will be the greatest opportunities for investors in 2024, and what will be the big trends that everyone should keep an eye on?
So, first, let's say some general principles about running money. If I can give the simplest, let's say, advices on that front is, first you need to stay invested. Because, you know, when you open, in the next 20, 30, 40 years, each time you will open a newspaper, you will only see, you know, you will see probably a lot of bad news. And these bad news will incite you not to invest. But actually, if you look at the very long-term track records of financial markets, there is a natural trend for equity markets to move up. Okay, so let's say if you are 20 years old today, and for the next 10 or 20 years, you stay 1% invested in equities, or at least 70 or 80% of equities, of money you don't need to access, really money for the long run, you will probably outperform anyone trying to time the market and only investing when things look nice. Okay, so that's the first principle: is stay invested. Principle number two is money weighted average. So that means that, let's say, every year you are able to save a few thousand euros or a few thousand Swiss francs or a few $1,000s. If you have this discipline of every quarter or every year to invest, some of your available cash into equities, and why not also into bonds, and then you do this on a regular basis, that's one of the free lunch you have in investing, because you will always win. If markets go up, what you invested before is making money. If markets are going down, that means that you will be able to buy these assets at a cheaper price. Okay.
Yeah.
The other free lunch in investment is diversification. Yes, you can become rich by taking concentration risk, but that's again a very risky bet. But by diversifying, you will preserve, let's say, the value of your assets over time, even during, let's say, bad times. Another key principle is riding winners and cutting losers. There is this very bad habit of saying, oh, I'm up 15% on this stock,
Yeah.
I'm selling, or I'm losing 20% on this stock, I don't want to take a loss. Actually, very often it pays out much better to ride the winners and to cut the losers, because we live in a very Darwinian world. So the strong get stronger and the weak get weaker. That's humanity. That's how the world looks. Look at the Magnificent Seven.
Mm-hmm.
These companies that are getting stronger and stronger.
Mm-hmm.
If you will have, let's say, sell your Apple or your Nvidia or your Amazon after 10, 20, 30% profit a few years ago, you will have missed a huge rally. Whereas if you would have, let's say, kept some of the losers within the tech world, you would have continuing losing money. So you really need, it's a bit counterintuitive, but it's really good to let's say, to stay with the winners and to avoid or to cut the losers.
Mm-hmm.
And also, last one is contrarian investing. Be careful when the crowd is overly optimistic about one thing, because the consensus, the crowds, is usually right except at turning points, and turning point can be very painful. You can look at history. Each time there has been a crash, the months before, the investment world was overly bullish on the market. So no, the consensus is wrong at turning points. So be careful when the whole consensus is looking at just one direction. Even also on the bearish side, it's look, COVID, end of first quarter 2020, the consensus was the world was going to fall apart. It was one of the best entry points in the markets ever.
Yes.
Okay, that's or March 2009, great financial crisis. Many people believe that coming to the end of the world, that it was going to be 1929 again. It proved to be a fantastic buying point. Okay, so these are for the big principles. Now back to your question: where to invest? So first, we live in a world which is a bit different than the last decade. The last decade was about deflation or disinflation. The last decade was about interest rates being very low and quantitative easing. So the Fed, and the other central banks printing money. The last decade was very peaceful. There was no big, let's say, war. There were a few wars, but not like we are currently seeing. Nowadays, you have a lot of geopolitical risk. You have inflation, which is going down or which is pretty high. And then you have central banks, which are much less accommodative than before. So this creates some risk, so you need to be careful. This also creates some downside risk for bond markets. So you need to look at ways to protect yourself against inflation, and you need to invest. Staying in cash is not an option in a world of high inflation, but taking too much risk is also not something which is great in a world where there are a lot of geopolitical risks. So the way we invest our portfolios is the following. So first, we like equity markets, especially companies with high pricing power. When there is inflation, you need to protect your profitability, you need to protect your margins. So you need to have, let's say, a business model with a lot of pricing power. So think about, if you talk about tech, think about Apple. The iPhone has been able to rise, prices over the years, and no one was able, let's say, to really, blame them, and they continue, let's say, buying the phones. Amazon has pricing power, Alphabet has pricing power, Nvidia has pricing power. Okay.
Yeah.
But also, you have some luxury companies having pricing power, so industrial companies, healthcare companies. So it's possible to find these companies with pricing power across different sectors. Okay. Two, obviously, when it comes to equity markets, we like a lot the US because there is superior return on investment capital there. But there are also interesting opportunities outside the US. Think about Japan, for instance. Japan has been doing nothing during 30 years and is just starting to break out on the upsides. Why is that? Because inflation is back to Japan. It is actually helping, the economy, in the sense that instead of having deflation, they have some inflation, and this is, let's say, forcing consumers to spend, companies to invest, and also there are a lot of corporate governance changes happening in Japan. So Japan is starting to run companies for shareholders, which wasn't the case before. And by the way, this is why Warren Buffett is currently investing into Japan. India is very interesting.
Yeah.
India is one of the, let's say, winner of what we call the East-West divide. The fact that China and the US, for instance, and Europe and Russia are not, let's say, in a very good terms. India is one of the winner of this. You probably saw that, some of the iPhones are now manufactured in India. A lot of things are happening in India.
So it's a great potential in Asia.
It's one of the, let's say, country which is the best position within Asia. So that's for the equity side. So we encourage, despite all of this risk, our clients to stay invested in equity markets. On the bond markets, the bad news is that bond market doesn't like inflation. Bond market doesn't like central banks to be too restrictive. But the good news is that finally there is some yields. If you look at corporate bonds in dollars, you can find 5-6% yield to maturity in some very decent names, issuer names. In Europe, it's slightly lower, but it's possible to secure a very nice coupon with issuers of very decent quality. And last but not least, beyond equities and bonds, you can also consider, for instance, gold as a diversifier.
Yeah.
We also like digital gold, like Bitcoin, as a potential diversifier in the long run. So here, we are really talking about portfolios which needs to be nicely diversified, which needs to adapt to the current state of the world, which is different than last decade.
Yes.
So again, investing in time of high inflation is different than investing in time of deflation. So these are, let's say, our advices to clients.
And what do you think about liquid alternatives or illiquid alternatives in terms of diversification?
Yeah, so for those clients who accept, let's say, lower liquidity, we will indeed encourage them to look at private assets and hedge funds. Hedge funds, there are some interesting macro strategies which are currently doing well. CTAs can also be interesting. We also like equity long, short, market neutral. And then within private assets, we have some interesting strategies on the small to mid markets in Europe in private equity. There are some very interesting and attractive valuations in these segments. So by the way, we are launching a new private equity fund of funds specifically dedicated to European small to mid-size buyouts.
So you invest as an institutional investor in private equity funds and
Yes.
hedge fund strategies?
Yes,
Okay.
exactly. Private debt can also be interesting because a lot of companies currently are looking for financing, and they are ready to pay, let's say, interesting coupon for this. So yes, private assets is definitely, let's say, one area of interest for clients willing to accept, let's say, longer duration.
Charles, looking at the world right now, what worries you most?
I think that the biggest worry is I think it goes with it's the 3Ds, okay? So you have the D like deglobalization. I think that's definitely, I say, deglobalization is a sense that you can see that big powers are, let's say, working less together than before. Think about US and China, the relationship is breaking. Europe and Russia, the relationship is broken for probably a very long time. So that's the deglobalization. The other D is debt. Remember that there was a big crisis in 2008, 2009. It was a debt crisis, but it has been solved by more debt. Money has been free for years, and the amount of debts within G7 countries is an all-time high and is rising very fast. And the reality is that this debt now is much more costly than before. In 2023, there's the first time ever when the interest paid by the US on their debts was higher than their defense budget. So they are spending more to just pay the interest rate on their debt than on defense at a time where the world is deglobalizing. So that's quite scary. And the last D, which is an issue, is demographics. In Europe, its population is becoming older and older. There is also a demography issue in the US. There is a demography issue in China. And bad demographics means low growth, also creates some pension fund risk. And so that means that when you have high debt and you have less and less people to pay taxes and to contribute to growth, then you are creating a big issue. So these 3Ds are kind of, because deglobalization also means a lot of geopolitical risk happening. Yes. That means that you create a lot of, let's say, bubble bursting risk. And demographics, you're creating, let's say, not only a growth risk, but look, there is one of the components of inflation nowadays is the fact that wage growth are rising too much because of labor shortage. And labor shortage is partly due to demographics. So you can see that 3Ds it's a kind of, let's say, very toxic cocktail. And these 3Ds needs to be monitored very carefully.
Now a little bit about the industry in general. What are the biggest changes you've seen, and are there any big changes coming soon?
So there have been many changes. But what I can see, in 25 years, the big difference let's take the example of private investors. Private investors nowadays, first, they are much more knowledgeable than 25 years ago. They understand finance.
Okay.
They understand and they are curious. They know the stuff. They have much more access to information. Before, information was just in the hands of the banker. You needed to rely on sell-side research, like research from Goldman or Morgan Stanley. These days, there is X or Twitter.
Yes.
There is, there are all of the forums, on Reddit and so on, LinkedIn. All of the websites. You can find all the information you need. So they are much more informed. Three, it's a very digitalized world. We all want to get something just by 2 or 3 clicks. We get very impatient when we don't get something after 3 clicks. So that means that the banking world, the financial world, needs to move digital, because otherwise you create a lot of frustration. These days people don't really care to, let's say, visit the banker in a bank and so on. They just want to quick and high quality access to information. So this means that, let's say, the financial world needs to let's say, adapt this digitalization world. And then the other one is, most of the, let's say, investors, they private clients, they are in the do-it-yourself, like IKEA, for the let's say, furniture. I think it's the same for financial world. Most of the private clients, they say, I don't need my banker for everything.
Yes. Okay.
If it's just to put some trades on Microsoft and Tesla, I can do it myself. And then they want to access also to strategies which were not available to them before, like, for instance, private equity. They want to get access. They want to trade themselves, so they want, let's say, an access to an app, a digital app to trade themselves. They want direct access to cryptos, and so on. So
Yes.
I think the young private, investor, private clients, is again much more knowledgeable, have access to information, wants to have, let's say, digital access, wants to do it yourself, and wants to access unique strategies. So I think that the bar has been raised, and also they want transparency on fees, and they want to negotiate on fees. So you need to come with higher quality advices, and potentially at a lower price than before. Yeah. So that's a very big challenge.
Let's dive a little bit deeper into Syz Bank. Syz Bank is a Geneva-based private bank founded in 1996, among others, by Eric Syz, and today manages about 25 billion Swiss francs. Eric Syz comes from a well-known Swiss industrial family, and his ancestors also include one of the co-founders of Credit Suisse. So was Syz Bank initially conceived as a family office?
No, it's a very interesting story. So the Syz family is coming from let's say, a family of Swiss industrial entrepreneurs. At some point, they indeed ventured into the financial world, because they were, let's say, among the founders, the co-founders of Credit Suisse and Zurich Insurance. But then they moved away from these two businesses. But Eric Syz, so the founder of Syz Bank, didn't want to pursue a career into the industrial world. So he studied in Switzerland, but then started to work for Lombard Odier, then moved abroad to the US in the 90s, early 90s, where he discovered the hedge fund world, and he told himself, well, I need to create a Swiss private bank where clients will have, let's say, the opportunity to invest into hedge funds. So this is how, let's say, he positioned the bank at first, and thanks to his network and also, let's say, the knowledge of his partners at the time, they launched Syz Bank, and it has been, I think, great success with very interesting growth in terms of asset management. And nowadays, it's I think it's pretty unique as a value proposal, family owned, with just one focus, which is really wealth management, with traditional, let's say, asset classes, but also private equity through Syz Capital. Again, not listed, owned by one family, no investment banking, no asset management, no use to a great extent of the balance sheets. So we have a very high tier 1 ratio.
What do you mean exactly by no asset management?
We have a few, let's say, Syz products,
Okay.
but most of the, let's say, funds in which we invest for our clients are third-party funds. So in some ways, we're kind of, let's say, it's called open architecture.
Okay.
So we are not biased towards our own products.
Okay.
We just want to select the best products for clients.
Could you maybe break down very briefly the different business areas?
Yeah, so three businesses. One is Syz Private Banks. That's roughly 15 billion, assets under management. Then there is Syz Capital, which is really targeting private assets, private equity in particular, but also hedge funds. And then there is a remaining part of Syz Asset Management, but which is only focused on Swiss institutional clients, mainly with some bond mandates. So it's not really about, let's say, a mutual fund that we are pushing, on the market. It's really, let's say, some solutions for Swiss institutional clients.
The Syz Bank went through some kind of transformation. What happened?
Yes, over time. So at some point we had one asset management company called Oyster Funds, and during years it has been a great success. But then one of the flagship funds moved as independent, and then it became a bit difficult to find another blue chip fund. So at some point we divested from this business. That's the main, let's say, change we've been going through. Right. Now, again, the focus is really on wealth management, and I think one of the, let's say, new venture for the Syz Group has really been this Syz Capital entity, which is focusing on hedge funds and private equity. So that's the newest, let's say, business of the group, and it's really, let's say, match the needs, the growing needs by investors to access unique private asset strategies.
Syz Bank has locations in Switzerland, Turkey, South Africa, and South America. Why exactly in these regions and not in the rest of Europe or Asia?
So, regarding Asia, we used to have an office in Hong Kong. We don't have this office anymore. Asia is super competitive, especially for, let's say, Swiss Private Bank. It's not an easy region. It's a region with a lot of potential, but it's kind of crowded and super competitive. Europe is maybe something we might consider, because also for cross-border and regulatory, let's say, reasons, it makes a lot of sense to have a European office, so that might happen. And for coming back to Asia, maybe one, let's say, option instead of being in Asia would be to be in the Middle East, because the Middle East is very close to Asia. By the way, a lot of businesses are also moved from Hong Kong to Dubai, for instance. So that's also something we are looking at. So let's say Middle East and Europe are two regions where we might, let's say, open an office in the years to come.
You yourself have worked in Switzerland for most of your career. What makes Switzerland a global brand for private banking? So why is Switzerland considered a safe haven even during times of turmoil? And what advantage does Switzerland still have today, especially for private banks and wealth managers?
Well, in the past, Switzerland was a lot about bank secrecy. We know that these days are gone. But that being said, Switzerland still remains, let's say, the flagship of private banking worldwide. I think there are two main reasons for this. The first one is the stability of the country. We are probably the most stable country worldwide. It's very rare to see any big political change. The country also has a very strong currency, very strong macro fundamentals. So it's kind of, let's say, again, when you let's say send your money into a bank, you want this money to be safe first and foremost. If you make a bit of return on it, that's great, but you first want this money to be safe. So I think that's the number one. And the number two is the quality of service. There are great private banking centers around the world, but none of them is able to match the credentials in terms of quality of services of Swiss banks. And this is the feedback that we get from, let's say, many clients. So I think, is the stability, the safety offered by Switzerland, coupled with its high quality of services and competences, are still making Switzerland very unique. There is competition, from Singapore, from Dubai, from London, from the US, from Germany, but Switzerland is still very unique.
For you personally, what is the purpose behind your work and what do you want to achieve or maybe pass on?
Yeah, so I don't have, let's say, the pretension of being able to say the word I want, and I don't know, many colleagues will be able to do that. But on the other hand, I hope to be able to do two things. One is to, I think, sharing knowledge. I'm making sure, I hire enough, let's say, young people passionate about finance to be able to share this knowledge. That's point number one. And point number two, the good thing with finance is that you can earn some money. So I hope to be able to have time and say financial means to invest into philanthropic let's say ventures and missions in the years to come. So at this stage I'm obviously very focused on my day-to-day job, but that's something I would love to do in the years ahead. So first, let's say sharing knowledge, and two, let's say giving back.
Great answers. Thank you very much for your time.
Thank you so
Really
much.
appreciate
Thank
it.
you. Yeah, thank you.